Good afternoon, this is Rupert Thompson, Chief Investment Officer at Kingswood Group. It's the 12th of April and I'm now going to run through recent developments in the markets and our thoughts on where they're headed. Well, global equities have had a strong couple of weeks, with markets gaining a further 1.8% in local currency terms and 2.8% in sterling terms over the past week. And now, year to date, they're up as much as 9.3% and 7.7% in local and sterling terms respectively. At the start of the month, this buoyant mood seemed in sync with the start of spring. But now, as I stare out of the window at the odd snowflake, I think I'm going to have to fall back on rather more prosaic fundamentals to explain the cheeriness of the markets. The Fed, the Federal Reserve, has certainly done its best to maintain the market's bullish mood by reiterating its dovish message. It is saying it will be some time until substantial further progress is made on achieving its full employment and inflation goals. And that's the condition it's set for starting to scale back its QE, its quantitative easing program. The Fed is also still not forecasting any rate rise before 2024. Down the road, sure, it could well bring forward its liftoff date, and an increase in 2023 is quite possible. However, following the marked rise in Treasury yields over the last couple of months, the markets are now pricing in as many as 3 rate hikes that year. That definitely does look excessive and helps explain why yields have stabilised in recent weeks, easing worries that the bond seller might derail equity markets. The IMF has just released its latest World Economic Outlook, which is relatively optimistic. Its forecast for global growth has been raised to 6.6% and 4.4% for this year and next, with the US accounting for the lion's share of the upward revision on the back of the large fiscal stimulus which is now in place. Equally important, the IMF now believes that COVID-19 should cause considerably less long-term damage to the world economy than the global financial crisis did. Emerging economies, with the exception of China, are expected to come off worst, but somewhat incredibly, US GDP is now forecast to be higher in 3 years' time than the IMF had been forecasting pre-COVID. Hopes of a strong rebound in the global economy are reflected in the 30% gain in corporate earnings, which is now expected for the world this year. Estimates have been revised up substantially since last summer, and the US has very much been the driving force. Earnings in each of the last 3 quarters have in fact ended up beating expectations by as much as 10 to 15%. This Wednesday will see the US banks, the big US banks, kick off the first quarter reporting season. The consensus expects US earnings to be up a hefty 25% on a year earlier. The market's focus, though, as ever, will be on company guidance for the rest of the year, as much as the results for the quarter just finished. We believe the medium-term outlook for equities remains positive and prospective returns remain significantly higher than for bonds. That said, equity markets have clearly come a long way and are now pricing in quite a lot of good news, and at a minimum, a pause looks overdue. Fed Chair Jerome Powell last week said that the US economy is at an inflection point, with growth and hiring set to accelerate. But he also admitted the pandemic still poses risks and that new surges of COVID-19 could impede the recovery. Here in the UK, the rapid vaccine rollout and sharp fall in infections is clearly reassuring. Even so, the speed of the forthcoming recovery remains uncertain. UK individuals are on course to have accumulated a massive £180 billion, or some 9% of GDP, in their bank accounts since the pandemic began. However, it is far from clear to what extent people will spend this pile of cash, particularly as these savings have been built up by wealthier individuals who are rather less likely to go out and spend it. Still, a chilly outdoor meal and drink at a pub might be looking rather tempting. Well, that's it for this week. Thank you for listening, and I'll be back again next week.